And number 9 is the balance of which account will appear in the debit column of the trial balance. The correct option will be A, carriage inwards. Discount received is credit because this is income. This is always credit, and provision for doubtful debts is this is always the credit side of the trial balance because this is anti asset. Asset is debit and this will be credit. Purchase returns, purchases are debit and purchases return are credit, so A option will be correct. And 10, Illa returns business premises. She owed rent at both the start and the end of the financial year. How can rent payable for the year be calculated? A option, rent paid less amount owing at the start of the year, and B option will be correct. Rent paid less amount owing at the start of the year plus amount owing at the end of the year. When we will make the expense account, if we have balance at the start of the year, that was our liability that was owing at the start of the year, that will be deducted. And the end of the year, if anyone accrued or owing at the end of the year any amount, that will be added in the rent expense. So we can see in the next slide, this is rent expense account, and balance will be uh, credit. Opening balance will be credit because this is our liability, this will be our liability, so this will be recorded on the credit side. And when we will paid rent expense, and expense always debit, rent expense to bank, and this will be debit, so it will be recorded on the debit side. Bank will be in the particular column, and this can be uh, any date, like I have written 22 January, so this will be any date, 30, 20, 15. And on 31st we will take the closing balance. This will owing, if we have owing balance accrued expense, so it will be on the debit stake in the debit side. It will be credit balance, it will be liability that will be transferred in the next year on the credit side, like we have in this account. And Bashir maintains a provision for doubtful debts of 3% of the trade receivable at the end of the year. On 31st August 2017, trade receivable amounting to $70,000. On 31st August 2018, trade receivable amounting to 733,000. Which double entry should Bashir make on 31st August 2018? And A option will be correct. Income statement 90 to provision for doubtful debts account 90. It means there is increasing the provision, so 90 is increasing the provision. This will be taken as an expense in the income statement. We can see in the next slide the whole working. And in 2017 there are 70,000 trade receivables, multiply 3%. That provision for doubtful debt is in 2017 2100 2100. We will make the we will transfer provision for doubtful debt in the income statement 2100. We will close the provision for doubtful debt in the income statement 2100 as an expense. And in 2018, 73,000 multiplied 3%, that will be 3% of 73,000, 2,190. Provision increased by $90 in next year in 2018. 2190 less 2100 because uh, we have already balanced 2100 and current year's total provision is 2190, and so we will need only $90 to increase this provision. So we will this increase in provision as an expense in the income statement, and close in the income statement debit to provision for doubtful debit debts credit 90. And 12 number is Leroy has an engineering business. On 31st May he received an invoice from AB Machines showing the following: cost of replacement part of the machine, cost of repairs to machine, cost of installation of machine. Which cost are capital expenditure in Leroy's books? A option is correct: machine installation, because from these four, cost of replacement part of machine, this will be revenue expenditure. Cost of repair expenses are always revenue expenditure. Cost of machine, this is capital expenditure. Cost of installation of machine, this is also capital expenditure. While depreciation charged on non-current assets? B option will be correct: to charge the cost of using the asset against income. We spread out the non-current assets cost uh, 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 from its to its useful life. And number 14 is Chris purchased a machine costing $15,000 on 1st January 2016. He depreciates the machine using the diminishing reducing balance method at 20% per annum. Which journal entry did Chris make on 31st December 2017? A option will be correct: income statement to provision for depreciation of machinery 2400. Provision for depreciation is expense, so it will be closed in the income statement, and provision for depreciation of the current years is closed in the income statement, not whole. For the current years, the provision of current years amount will be transferred in the income statement, and whole amount is transferred to the statement of financial position, that is deducted from the non-current asset in the statement of financial position. We will see its working in the next page. On 31st December 2016, depreciation of machine is 15,000 multiplied 20%. The first year depreciation is 3,000, and second year depreciation 31st December 2017 depreciation is 15,000 less 3,000, because this he is using diminishing balance method. So we will first find out the net book value. Net book value will be 15,000 less 3,000, that will be 12,000. 12,000 multiplied 20%, that is 20% of 12,000 will be 2,400. He will take 2,400 in the income statement in the 31st December 2017. And Hossam took out a 5-year bank loan on 1st January 2018. All of the money borrowed was used to purchase a delivery van. Under which heading will these items be shown in Hossam's statement of financial position on 31st March 2018? D option will be correct. Bank loan will be non-current liability, because non-current liability is when we take the loan for more than 1 year, this will be non-current liability. So it is more than 1 year, 5-year loan, so it will be non-current liability. And delivery van is non-current asset. Number 16, Beth provided the following information at 31st December 2017. Its opening capital is 1st January 2017, 26,000. Profit for the year is 3,600. Drawings during the year is 2,500. Long-term loan is $8,000. Beth paid a personal check to the business on 30th December 2017 amounting to $5,000. This will be considered as capital because this is his personal funds. So it will be fresh capital. It will be added in the capital. What was the capital employed on 31st December 2017? And D option will be correct, $40,100. How we will see in the we will see working in the next slide. Closing capital, we will see the closing cap. First find out the closing capital. Opening capital 26,000 plus profit, that is 3,600. Drawings 2,500 plus fresh capital. Drawings will be deducted, and opening capital plus profit plus fresh capital, and this will be 3,000 32,100. And there are different formulae for calculating capital employed. First is capital employed is equal to capital plus non-current liabilities. Second is total assets less current liabilities, and 3 number is non-current assets plus working capital, and working capital is equal to current assets less current liabilities. This is also called net current assets. Working capital is also called net current assets. So we have in this questions capital and non-current liabilities. So we will capital plus non-current liabilities, we will find out capital employed. Capital is 32,100, we have find out in this working, plus non-current liabilities long-term loan 8,000, and when we will add it both these two, we will find out 40,100.